FNB's Commercial Property Brokers Survey for the first quarter of 2021 provides some useful insights into the state of the owner-serviced part of the commercial property market when asking the property brokers for perceptions of the main reasons as to why owners are selling. And no surprises, I guess, that the biggest motive for selling, either in partly driven by that motive or fully driven by that motive, is financial pressure. So in other words, sellers selling to downscale to something cheaper, sending workers to work from home, going back in as a commercial tenant into the rental market, whatever it may be. It's estimated that 65.2% of sellers are partly or fully motivated by financial pressure. That's virtually unchanged from the previous 65.3% in the fourth quarter of last year, but it's very significantly up from 40.5% as at the first quarter of 2020, just before the lockdown. So it's escalated quite sharply during the lockdown and hasn't yet declined. The fact that it's unchanged from the previous quarter's survey may just start to hint at a peak forming. Let's see in the coming quarters. Now, we look at, I like to look at other motives for selling from this survey for signs of financial constraints. And the two I look at is sellers motivated by, they want to sell in order to upgrade to something better or bigger, or moving closer to their market. Now, 9.3% of sellers are perceived to be selling in order to upgrade. So there are some, but that's down from the prior quarter's 12.9% and very significantly down from 22.1% back at the start of 2019 when we started the survey. So that has declined. With it, those selling in order to move closer to their market, 21.6%, but down from the previous quarter's 27.2% and more significantly down from 36.3% at the start of 2019 too. So you take the ones motivated by upgrading or motivated to move closer to their market, both have declined. That suggests an increased portion of sellers aiming to stay put for the time being. I suspect that that's partly motivated by financial pressure in this recessionary environment, but also partly motivated by perceived uncertainty about the future economic direction. Will the economy recover? How quickly will it recover after a very big recessionary knock during the course of last year? So an increased portion of sellers perhaps just staying put, bar those who are financially pressured. We then look at other parts of the market, parts of the commercial market, to see whether there's some sort of heads up leading indicator which may suggest a turn for the better. And one finds it in the tenanted market perhaps, where you look at TPN's data, and from 50.36% of tenants being in good standing with their landlords in the second quarter of last year, a very low number during lockdown, we have seen some improvement to 61.6% by the fourth quarter of last year. So there is some improvement, but at the same time, if one looks back to pre-lockdown, 78% of tenants in good standing was a much better number. So it's still a seriously financially constrained environment as at late last year for the tenant population, despite some improvement. But nevertheless, improvement is mildly encouraging. We also look at liquidations data provided by Stats SA, and you can see that for the 6 months to February this year on year, 20.3% up. That's a significant surge that's happened, as one would expect. But that too, for the 6 months to January, was nearer to 24% year on year. So we've seen some slowing in that growth rate too, which may just point towards some easing in financial pressure starting to take place in the coming months as the economy revives gradually post the hard lockdowns of the second quarter of last year. So there are some little signs of in other parts of the economy and market that things might be turning for the better from a financial pressure point of view. And I just suspect that what we may start to see is this percentage of sellers selling due to financial pressure in the owner service market just starting to decline in the coming quarters as well. In other words, we may be starting to turn for the better. Now, what we've also seen in some of the numbers, which must be pointed out, is liquidations, the surge up into the 20s during this most recent recession, is significantly lower than the surge to 45% year on year at a stage of 2009. That was the global financial crisis recession. That recession was a lot more mild than this one, but the difference was that time round we had rising interest rates going into it. This time round we've had sharp interest rate cuts by the SARB, very proactive. And I do believe that that's the difference. So the financial pressure this time round doesn't seem as bad as the global financial crisis. And the big difference, I believe, is the interest rate direction. So the interest rate cuts during last year, I believe, cushioned the blow to a significant extent. Didn't mean that financial pressure wasn't significant, but it would have been far worse if we'd had that GFC 2009 situation where we'd approached this crisis with very significant increases in interest rates and not as proactive a cutting approach by the SARB as we headed into that recession. Interest rates have made a key difference in cushioning the blow this time around. But nevertheless, financial pressure is high, but just looking like there's early signs of turning for the better.